Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's go a little technology here. You're thinking about some of the big tech names and how are they going to deal in a world where tariffs are going to be higher on a global scale? You think about some of these big tech firms and they sell their hardware and software and services everywhere. So they are truly global. Anurag Rana joins us, Bloomberg Intelligence Technology Analyst. What's the tech call in a higher tariff world, Anurag?
Oh, it's so bad right now. I mean, look at Apple. It's really surprising that they racked up so much on China. Now that's going to have a massive impact on Apple. Most of the products are made there. You can cut it and slice it in any way. They cannot offset the margin risk. The iPhone sales are going to be dramatically impacted in the second half, most likely. It's going to we will see how China reacts to this. China accounts for 20% of sales for Apple. So the local population, let's see if they're going to go with local brands. I mean, it's just a big mess for Apple, frankly, at this point. But when we look at the other vendors, when you look at the software companies, which even though they don't have the direct exposure to China, I think when you look at an economic slowdown like this, you're going to see brakes on technology spending. And by default, a lot of what these guys sell to the market. We looked at growth estimates. As of December 31st, the top 50 software companies, they had a median growth rate of 13.2%. 2 days ago, we looked at it. People have not brought their numbers down. It's still 12.4%. So we think that number gets cut down by quite a bit over the next, 1 month, 1.5 months.
And that's not in the stocks yet.
I can't tell whether that's on the stocks or not, but it's definitely not in the sell side estimates consensus out there.
Well, here's what I wanted to kind of pull back a little bit. We talked about this with Mike, sort of what the headline and tariff risk is, and then what the actual fundamentals of the tech industry. And that brings us to the news that Microsoft, that Bloomberg broke, has pulled back on a bunch of data projects, right? And there was a whole list, right? UK, Indonesia, Australia, Illinois, North Dakota, Wisconsin, etc. So how do you read that? Like, is that a sign that we're paring back everything and it's all over, or what?
No, how do I read that? I will wait for Satya to make his comments on the conference call, because there's likelihood that he may say, listen, I'm happy to lease that same amount, just not build it. So from that point, it's okay with me because they're still seeing the inference coming in and they're still going to spend the money. They are just deciding not to build it themselves, which is fair. I mean, it's, either rent or buy. I mean, it's up to them. So I think those are going to be the most critical comments. Yeah. But it's tough for me to see how any executive can give any decent guidance into going into, this particular environment, later this month.
So important. Rent versus buy. Okay, this is why I had that tutorial with Anurag. This is why you got to do a call. You got to call him up after the show for half an hour.
Yep.
And then you will understand all things.
Tom Keene watching the show here, trying to learn.
He's just jealous that he doesn't have the tutorial for Anurag.
Exactly.
Okay, so then if it is just the tariff impact, then if that's really like what is rocking these stocks, which companies are most exposed? Like, which software companies are going to be hurt the hardest?
See, I think Apple's the one, we talked about it. But then you have to look at it where the valuations are still higher than pre-pandemic levels. Look at somebody like a Shopify. It's down huge today because their valuation's a bit high. ServiceNow, they have a lot of Doge exposure as well. So there are names out there that are far more, on that value range, where are far more expensive than historical norms.
Again, but we're not making a valuation call here, are we?
No, not at all. No, we are.
Because there's still risk to estimates is probably a reason.
Massive risk to estimates. And we don't know where the growth is going to be in the second half right now. Yep. And we have seen in the past recessions, things dry up very quickly.
How's actual demand for iPhones? This might seem like an insanely rudimentary question right now based on all we're dealing with, but what's the underlying move there?
If you were to ignore everything on the tariff side, the demand was just in line with what it has been in the last 2 to 3 years. So we are not seeing a major spike in demand. Although in some Western countries where they have launched Apple Intelligence, they have seen some improvement, but China has still been weak, and that has been the big story with Apple. And what we were hoping by the end of this year, fiscal year, September, October, when they launch the next phone, Apple Intelligence will be in all the major regions. The new phone form factor come out, the slim iPhone 17 that Mark Gurman talks about, and all of that creates a new excitement. But I mean, everything is fair game at this point.
All right, Anurag Rana, appreciate that. Anurag Rana does all the technology stuff for Bloomberg Intelligence in our studio. How big is that? I mean, that's because you had your big AI conference yesterday, which was extraordinarily successful. I stopped by a few times. The room was packed.
It was really fun, actually.
Jennifer, you hosted a panel, right? Yeah, exactly.
I learned things.
Yeah, you learned things. So it's good stuff. So anyway.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix here alongside Paul Sweeney and John Tucker. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Let's pick up on what John Tucker was just talking about in terms of Stellantis temporarily halting some production in Canada and Mexico. Ford already offering steep discounts to keep customers coming into the showrooms. Volkswagen warning dealers it's going to tack on import fees to the vehicles it ships to the U.S. because today those 25% tariffs on imported cars are already on the docket. Joining us now, Steve Mann, Bloomberg Intelligence Global Autos and Research Analyst. Can you walk us through these kind of ripple effects, right? Like steep discounts, getting them into the showroom, like Volkswagen, doing import fees. Like what does that roll out to look like?
Yeah, I was just having some calls this morning with some clients, and that was the big question. You know, how much of that tariff cost can they pass down on to the consumer? It's a big debate. It really depends on the automakers, but in general, I think the automakers will have to eat that cost because we're actually facing a downturn in the auto industry. Inventories are high. If you look at delinquency rates on auto loans, they're at a very high rate in the last few years. So I don't think consumers are willing to open up the purse strings any further.
So, Steve, why are Ford and General Motors down? This is my dumb question of the day. Wouldn't the domestic automakers be positive today while the internationals would be down because of the tariffs? Aren't these tariffs designed to protect the domestic auto manufacturers?
Yeah, Trump's announcement of the reciprocal tariffs, it gave, quote unquote, reprieve or exemption on autos. Not really, right? Because they already announced the 25% tariff last week.
Nothing more additional, I guess we should say. Yeah.
So I guess you're right. I mean, no news is good news at the moment. But I think the stocks have trended down quite a bit since last week already. But it's not done yet, right? Because there's May 3rd is another deadline on auto tariffs. That's when they're going to announce how are the parts that do not meet the USMCA, or not just USMCA, that do not meet the U.S. content rule, quote unquote, U.S. content rule will apply to auto parts.
But to that point, it's just currently the tariffs are in place for already made cars coming into the U.S. We get the auto parts one, as you point out, coming in May 3rd. Are you surprised at Ford sort of lowering and offering discounts to get people in their showrooms right now? Like that would feel like the opposite of what you would expect with tariffs in place.
Yeah, this is what I said earlier. I think the automakers will have to eat these tariff costs.
So that's what they're. I see. So that's how they're eating it. I see.
Now they're going to have to lower the costs. Definitely not raise the cost, but like I said earlier too, it's coming in a bad time where inventories are at pre-COVID levels.
Really? Wow.
So they're and the consumers are not buying as many cars as they would. So they're going to have to not only eat it, but have to, like in this case, Ford will have to even cut prices.
What does this mean for the transition to electric vehicles? Because it felt like for the U.S. OEMs, they were almost doing it begrudgingly because they kind of had to. The market was going there. They didn't really want to. The economics weren't there. Now I've got pressure on my core business.
Yeah.
Does that slow down, do you think, or is that going to impact the move towards EVs?
There's always been a debate. Right now, battery EVs are about 8-9%, penetration in the U.S. market. There's debate in terms of if that's going to grow, but I think that's where, in this segment, that's where we actually will see clearer winner and losers. I actually think the pure plays, the Rivians, the Lucid, and the Tesla will be clear winners. because if you look at the legacy automakers, they're actually building a lot of these EVs in Mexico to bring down costs. They offer a more attractive prices for consumer. But now with these tariffs, that they're going to have to raise prices on EVs, not really cut prices to bring in consumer. And unfortunately, GM was actually on their way to profitability on EVs, and that's gonna, these tariffs are gonna derail that effort.
Do you really think that we're gonna see Ford, more like GM, build more auto plants in the U.S.? Is that actually gonna happen?
I think with the global tariffs, with the auto tariffs plus the reciprocal tariffs, it's actually upending this supply chain that's been put in place since 1965. First kind of auto agreement between U.S. and Canada, which was called the Auto Pact. These tariffs are upending that, and I do think that these U.S. automakers will bring vehicle assembly back, and it's going to have a ripple effect because they're going to force a lot of the suppliers to come back to the U.S. as well. So we don't exactly know how much it'll cost. We've made some estimates. It can cost upwards of over $4 billion just to construct a new plant, a greenfield plant one greenfield plant in the U.S.
Any of the companies you covered, have they talked about? Have any of the companies that you cover, have they talked about we're willing to make that investment?
Have not, but I bet there's going to be a lot of questions during the earnings calls.
They're going to talk about it, though.
Yes.
At this point, they got to talk about it. Which company do you think is best poised to actually do that if they were to pour some billions into that?
I still think the U.S. automakers will actually, relatively speaking, will be better off than, say, the Europeans and some of the Asians like South Korean, because the U.S. automakers do have additional capacity in the U.S. that they actually can bring that capacity, shift that production back into the U.S., where the Europeans and some of the Asians will have to build greenfield sites, which could cost about $4 billion for a plant.
Wow. And I have to build it in Tennessee or South Carolina or Alabama, one of the non-union states, and there you go. They've already done that. All right, Steve Mann, thanks so much for joining us, Steve Mann. He's a global autos and industrials research analyst for Bloomberg Intelligence, actually in New York City here today in our Bloomberg Interactive studio. I know. So many people can say that.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We are brought to you right now from Interactive Broker Studio right here in Midtown Manhattan. Also check us out on YouTube as well. All right, let's go to another area and sector that will obviously be quite impacted by tariffs, and that is shipping. Lee Klaskow is Bloomberg Intelligence Senior Transport, Logistics, and Shipping Analyst. So, Lee, if I game this out, I see a couple things. One, trade flows reroute. So the shippers are still doing stuff. They're just doing stuff in different directions. Or we see trade really start to shut down. What's your base case?
Well, we've been saying for a while that tariffs are not good for the freight markets. And the reason for that is obviously they're inflationary, and the consumer is a big part of the U.S. economy. So it's going to have an impact on things that we import. So it's going to impact companies like Maersk and Hapag-Lloyd and Klaskow. Those are marine shipping lines, because they'll be hauling less containers from Asia to the United States. It'll impact railroads such as Union Pacific and CSX, because they'll be hauling less freight. It'll impact truckload carriers and LTL carriers, and it also is going to obviously impact the parcel carriers like FedEx and UPS. And we're kind of seeing that in the market right now. The Dow Jones Transport's down, over 7%. Well, the general market's down around 4% right now. So, these are highly cyclical names, and they're really, the demand really goes with where the economy is going. And what this is telling us is that it's going to be a hit to the economy, what was announced yesterday after the close out of the White House.
So, Lee, I spoke with one of our favorite transportation analysts earlier this morning, Tony Hatchett. Now I get to speak to Lee Klaskow, so this is a good day here.
I was going to say, ouch, that hurts.
Two of my faves. I worked for Tony way back in the day, and I worked with Lee at BI, so it's all good. Lee, I mean, if you're CSX or Union Pacific, you're kind of just waiting to see what your customers like Ford Motor Company or the farmers are going to tell you about what they need in terms of demand. Are you hearing anything now about bookings or any of that kind of stuff?
I mean, what we're seeing, so, obviously what we're seeing in the liner market is a couple of the liners have announced blank sailings. And what that means is that they're either going to, skip a port, or they're just going to discontinue a whole loop of a ship going from Asia to the U.S. and back to Asia. So we're starting to see that now. And we actually saw container rates, trans-Pacific container rates actually spike a little bit this week, and that's really been driven on that and some general rate increases. So we are starting to see that. And then, you have to remember, there was a lot of pull forward demand ahead of these tariffs, right? And so what that's going to do is that means inventories are full right now. And so that's going to create very difficult comps in the second half of the year. And, when we were seeing intermodal volumes up mid to high single digits, you could see that going to declines in the second half. So, and that's, intermodal impacts railroads. So all the railroads, so, we mentioned Union Pacific, and it also impacts Norfolk Southern and Berkshire Hathaway's Burlington Northern, also impacts big players in the intermodal business like Hub Group or J.B. Hunt or Schneider. So, the impact to the tariffs are really going to be felt for transportation companies. And that's all assuming that these tariffs stick, right? If tomorrow the president wakes up and says, forget about it, then game on, right? It's like that Wayne's World scene, yes. Game off, game on. So, we could be, back to normal, because, what we were really banking on this year was a freight recovery for the truckload sector, and kind of the truckload sector also does impact other aspects of the freight economy. And that recovery really seems now to be pushed out a lot further than what we thought 3 months ago, when President Trump, got into the White House, and, we thought that this was going to release all these animal spirits and, low taxes, low regulation. That's going to be great for the economy. But then now we have the risk of tariffs, and, the end game is going to be interesting. So, like a company like Nike, they manufacture a lot of sneakers in Vietnam, but, an average sneaker worker, I just looked this up on the internet, so hopefully this is right. They make something like $250 a month. I mean, that manufacturing is not going to come to the United States. So what are the goals of these tariffs, right? Because, to bring that to the United States, obviously it's $20 an hour, 40 hours a week. That's a lot more than $250 a month.
But yes, to be sure. And I think that everyone doesn't necessarily know what the end goal is. Here's my really silly question, and I'm just looking in the shippers like Maersk or any of the actual shippers. If we're rerouting goods in a less efficient route, for example, does that actually mean that they make more money or no?
Yeah, so the near term, but any disruption is good for the shipping markets and transports and freight forwarders. But that good part is very short-lived, and so, we're not going to see all of a sudden sneakers manufactured in Eastern Europe. It's just that's where they're manufactured, so they're just going to be coming in, and they're just going to be more expensive, and we're just going to buy less of them. So it's not like we're not talking about like the Red Sea crisis, where the Suez Canal is pretty much shut down to the container liner market, or droughts in the Panama Canal, or a war in Ukraine. Those really impacted trade flows. It's going to take a long time to change where things are manufactured. Now, on the dry bulk side and the tanker side,
right.
I mean, that could get a little more disrupted, but a lot of those commodities are kind of exempt already, so they may not really be impacted as much as the container liner market.
Gotta leave it there. Lee Klaskow, Bloomberg Intelligence. Thanks a lot.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's get to some of the stocks definitely on the move. That's Nike. We were off huge here. I mean, this is the lowest level we've seen since November of 2017, the worst sell-off since June of last year. Poonam Goyal is Senior U.S. e-commerce and retail analyst at Bloomberg Intelligence. Poonam, this is a completely unfair question, but where is the bottom or the revaluation for the stock here?
I guess it depends on how are they going to pass on these prices, right? So, a 54% tariff on China, 46% on Vietnam, where Nike makes 50% of its footwear. These are big, big numbers. There's no way they can absorb even half of this. These companies have laser thin profit margins, high single digits operating margins, low double digits, maybe at best for some of them. It's just something they can't absorb. So prices will rise to the consumer, and the consumer will pull back. And that's where we struggle, because inventory will pile up again. If you talk specifically about Nike, Nike's in a position today where they need to get rid of excess inventory. And that's been the push that they've been pushing for the last 2 quarters.
And they were just kind of getting it together.
Yes, exactly. So now this happens. So does the problem become worse? I think so. I think as prices rise, consumers pull back. Now there's more inventory that needs to be disposed, and it's just this ripple effect that they can't escape. So things are going to get much uglier before they get better, or we think, even if they can get better.
So from the last, tariff scenario of several years ago, Poonam, did we learn any lessons there? Were the retailers able to pass along price increases? Did they end up taking it in the margin? What did they do?
So in the last round, there were ways to offset it. So what happened in the last round was it was only China that had the tariffs. So retailers shifted production out of China into Vietnam, into Cambodia, into Bangladesh, and they were able to diversify that cost exposure, but they didn't bring production to the U.S. Today, there's no place to really diversify it, and bringing it back to the U.S. is, I think, impossible. I mean, we don't have the infrastructure, we don't have the skilled labor to do this anytime soon, yet alone in years.
Right. So that's the whole point. It's like they already did this. So then they have to do it again. Like, where would they go? What other companies? I know Nike's getting hit really hard. You gave some incredible statistics in terms of how much they make overseas in, say, Vietnam. What other companies are going to be hit as hard?
So every company that manufactures in Asia will be hit. There's really no escape here. Allbirds, a very small company, 100% of their footwear is made in Vietnam.
Oh my
Adidas,
gosh.
39%. Lululemon, which before yesterday did escape the tariff front because they did not manufacture in China, now they have 40% of their manufacturing in Vietnam, I'm sorry. So they're exposed too now. So it's really everyone. Apparel, we are a net importer of apparel and footwear. We don't make it here. We don't make enough here to say we can bring it back here. It's in Asia, and the Asian countries across the board have very high tariffs on them, which is going to impact pricing and costs and margin.
Are there any brands, I don't know how to, are there companies that are going to be winners here? They're all American manufacturing and so on, and goods. And
they are, but they don't manufacture anything. So think about the resale companies, right? When you go, and these are much smaller companies, but when you go to a ThredUp, when you go to a Poshmark, when you go to an eBay, they're selling stuff that already existed in the marketplace. So as consumers seek these deep value, do they start thrifting more? Possible. It just depends on how high prices will go and how consumers will pull back. But these values-driven companies that offer deep, deep discounts, whether it's the off price even to some extent as inventory piles, or whether it's like a Walmart which offers just better pricing, we'll see consumers trade down. We'll see consumers pull back, and we'll see consumers seek discounts. It's a traditional retail cycle, but this time it's just big. The impact is really big on retailers.
And that's why the TJXs of the world, right, with the resale. So if you have the extra inventory, where does it go? TJX, and then that ramps up their own inventory and availability for customers.
Under Armour down 16% today. VF
Brutal.
Corp. These are American companies just getting hammered.
As long as I can get my Scanlan Theodore secondhand on Poshmark, that's cheaper than what they are now. It's a whole thing.
It's a whole thing.
Poonam knows what I'm talking about. All right, Poonam, thanks a lot. Poonam Goyal, Senior U.S. E-commerce and Retail Analyst at Bloomberg Intelligence, joining us.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.